How are you, folks? Enzo Di Costanzo, and today we're going to be talking about stock valuation from the Brealey Myers Fundamentals of Corporate Finance textbook. So away we go with the PowerPoints with this. Okay, so we're starting. I was working on this using this textbook a number of years ago, and this and that happened, and we sort of discontinued. Not discontinued, but I didn't keep up with what I wanted to keep up with. But this is a we're going to start up again the lectures for Brealey Myers. Marcus, I think, is a Boston College guy. So he's one of our Jesuit brothers up there in Boston. This is the eighth, but I think everything is the ninth edition. But I just happen to have the electronic version of the eighth edition of this textbook. This is a very popular corporate finance textbook. There's a couple versions. There's a principles version, there's a fundamentals version, and there's some other version. So I think there's about three different levels of this. So I'm using the I mean, this is good. Well, I'm saying fundamental, but this is pretty good. This looks like the Journal Square. I don't know if this is this probably is in Boston, but that's a nice picture of a downtown corporate landscape. McGraw Hill, right? A big publisher. I remember is a see here, yeah, MIT. So and then London School of Business. I doubt that's in London. That's probably going to be in Boston someplace. That picture, Boston College. Dr. Marcus is out there, and I'm trying to get to the fast or the quick summary of the book. I taught this out of this textbook at Rutgers, and I've used a lot. I've used this book a lot. And when I was at Fordham, we used it at Fordham as a student. I used it at Fordham, and we took about three. Yeah, that's what I wanted. We had about three different levels of corporate finance. It was like the fundamental one, and then principles, and then there was an applied class. But a few years ago, I taught goals and corporate governance of the corporation, financial markets institutions. This is I have a Home Depot example for accounting and finance. These three and four are pretty much together, measuring corporate finance, the ratio analysis, time value of money. I've taught this chapter could take a whole 6 weeks. I've taught in past summers. I've taught that chapter, and we're going to hit this chapter now. Whoops. We're going to hit, valuing bonds, valuing stocks, but also valuing bonds is important. But all of these chapters, the 5 to 10 year, these are all the valuation chapters. At Rutgers, I taught here. I taught the special topics about 10 years ago, more than 10 years ago. Taught options, the merger mathematics. I taught that stuff. These other chapters here. This is the beta, and weighted average cost of capital, but risk return, opportunity cost of capital. That's the beta computations. These are I don't want to say the lighter chapters, but these are long term financial planning, short term financial planning, working capital management. That's all the accounting stuff, and you could tie these seven of them together. But I've taught out of here was a lot of work, and this I'm not really a portfolio guy, so I don't really hit these too often. The accounting is important. Legal reading, legal writing, legal research is important, and the accounting analysis is and doing everything in Excel. Those are the skills that I use. Time value of money is certainly very important. Inflation adjustment. I was sending around to some of my colleagues saying, "Hey, can you compute the real rate of interest?" And I'm waiting to hear back from I think all of them. Pretty much at this point. But what are you going to do? But like I said, so we're going to be hitting value stocks today. So we'll hit the PowerPoint version of this first. Okay, and as it says, and generally this is taught. Value a Home Depot, value an Apple computer, a publicly traded company where there's a lot of, there's a daily measuring of the equity valuation of the company, and you can convert that into to an enterprise value, equity value, as it's thinking about the accounting equation, alpha or assets equals liability plus owner's equity. I don't say you're just valuing half the company, but you're valuing the equity part of the company, where the debt part of the company, it's a little, not, I don't say cloudier, but it's not as accessible to sort of non-professionals, the prices of the debt, but you could always back out based on some sort of discount rate. You can always back out based on the cash flows, the debt insurance. It's a little bit of work and a little bit of time, but you can always back out those numbers. Anyway, let's focus on what we're here to talk about today. Understand the stock trading reports on the well, understand to be able to interpret them. I think is the better word. To understand is rather vague. To interpret stock trading reports and says financial pages of the newspaper. So you get in class. I was mentioning that to you guys that this is quite old, right? That the book was written a while ago. It was definitely written a while ago. Calculate the present value of a stock given the future value of dividends and the future stock price. And here's the thing, and I was thinking about this when I was looking at some of the Excel examples that we're going to eventually go over this week. So I'm going to get together about 4 of these videos. It says calculate the present value of a stock given the forecast of future dividends, which is like a cash flow, and then the future stock price, which it's like you're taking a valuation and then you're nesting it in another valuation, like sort of the overall valuation of what you're looking at here. So you got to be very careful with that. And I'll tell you something that I learned, and I'll tell you one of the reasons why, not that I deviated from using this textbook, but you need to know your accounting. Okay, that's really the most important thing. And learn accounting. You read a book written by a CPA, written by 3 CPAs. I think it's Wiley. I use the accounting principle, and it was a principles book, not a fundamentals or an introductory or anything like that. It was the principles textbook, and it took a while. But I read the 18 financial accounting chapters in there, and made video lectures and worked out all the problems. So um, you know that's you want that. You want it written by scientists or people who really uh, do it for a living, not just somebody who heard of this book. This is a popular book. I'm not knocking it, but it's a popular book. But there's things in there, especially when they give some of the definitions of cash flows and things of that nature, where I could maybe dispute some of their assumptions or some of their definitions in there, and how some of them the accounting materials is presented. But it serves a purpose. Okay, that textbook. So I don't want to sit here and turn this into a book review of the Breeley Myers book that's been around. Princeton uses it. It's been around a very long time. Use stock valuation formulas to infer the expected rate of return on a common stock, interpret price earnings ratios, understanding what professionals mean when they say there are no free lunches on Wall Street. And again, the last live classes in the fall of 2022, we hit some of these topics. Okay, so actually we're going to go to the PowerPoints next, and actually what we'll also do now, and of course I have a healthy collection of models. There's a bunch of definitions here. Now we're not going to go headfirst into the Excel today, but just know that that there's a bunch of models in here, and with mathematical notation. Dividend a year from now. See where it says P0. P0 means the value today. 0 means today. 1 is a period away. It could be a month away. It could be generally it's a year away, a month away, or something like that. So, which is dividend 1 equals ESPN 1 or ESPS 1, earnings per share 1. That means earnings per share. At the end of a first year of your studying period, the period that you have some time value of money computations here. This is estimating the value of Home Depot stock. I'm trying to think here. This is. Did I do this one? I don't recall if I may have. Yeah, this is some of the Home Depot stuff. Yeah, whatever your your time horizon is, we have to look at that at some point. Hopefully, yeah, that's the non-constant growth. Yeah, we'll get to that. We'll get to that. But Home Depot is sort of our our case study or studying company, valuing a business by discounted cash flows. There's an example there. This is the one I really sort of care about a little bit more. And actually, I'm engaged in some of this work right now, so I think that'll be pretty good at making some of these graphs. And actually, I folded in a statistical model, like a technical analysis model here of the returns of the S&P 500, and we'll get to that. So there's a lot of good stuff here. And then, of course, this is correlation, and we'll go through variances and volatility and covariances and standard deviation, and we'll go through correlation coefficient, what the beta is. Okay, and we'll look at this. We'll go through these definitions while we're here, and then the questions here. We'll hit these at another. Yeah, we'll hit these at another time. We're not going to certainly. I doubt this week we're going to have a lecture on the questions, but we probably could hit something like that. So, okay, so Yeah. So valuing stock. So this is actually even before we do that. Yeah. So valuing. I'm gonna. There's a reason why I'm staying like this for a second. There it is. That's why. So you have to remind them that you're still here. And it's a little, I've done that where I've done a lecture. It clicks off. It has this sort of. I apologize for that sound. It clicks off after about 10 minutes or so, or what have you, and you got to be careful with that. Man, recording. Okay. Okay. So valuing stocks and the definition of a primary market, the definition of initial public offering, the definition of a primary offering. So a primary market is the sale for new securities by corporations. Okay, and that's how corporations arrange financing by agreeing to pay a percentage of their earnings to some people who invest in their company. And it goes back to the accounting equation. It goes back to assets equals liability plus owner's capital or equity. So if it's a company where it's 100% a person, let's say it's a person, Michael Dell or somebody, Warren Buffett, even, a person with a very large bank account and makes an investment in a specific company, you make some, maybe not all the earnings, or maybe 90% of the earnings, and then maybe the people running it as a sort of compensation, they'll get 10% of the earnings of the original idea people for the company. Uh, and Buffett would get like 90% of the profits of the company, kind of a thing. So the primary market, it raises capital or prepares financing based on somebody coming in and backing the company with cash, basically. And that company gets operated and set up and run and developed and researched and all those other kinds of things. Okay, that's where that's deep pocketed professional investors, people who do this for a living, uh, who are very much in the know and know the latest companies coming across the board, and there's a whole community out there that's focused and invested time wise and invested capital wise in the primary market. An initial public offering is an investment bank makes an investment in a company, let's say for theoretical purposes, $10 a share and whatever, a million shares or 10 million shares or something like that. And, some investment bank somewhere uh, makes an investment in a company out in California, the latest graphics microprocessor chip, or the latest technological innovation out in Northern California someplace. It's invested in by Morgan Stanley for whatever, $100 million or $50 million, something like that, and a couple million shares, kind of a thing. So let's say the price is, let's say however many shares it is, it's $10 a share. The Morgan Stanley invests $10 a share, multiplied by X number of shares, and a company in Northern California gets that cash. Morgan Stanley turns around and says, okay, well, we're going to trade the shares of this particular technology company on the open market, and we're going to price it out in the market at $20 or $30 a share. So if we sell all of our shares to pension funds or to investors out in the world, and they're speculating on and betting on the appreciation of the value of those shares, or the value increasing over time, and we invested $10 a share, and now we sold all their shares for $30 a share, let's say, that's they've made they've tripled or double tripled their money, whatever it might be, whatever the computation is. But they've obviously, they're making multiples of their initial investment, is the bottom line. That's what an initial public offering is. It's the first time that the public has access to buying shares of a company that otherwise wasn't available to the public, and it's already been invested in by sophisticated, high net worth professional investors, basically. A primary offering, the corporation sells shares in the firm. The difference between those, well, an initial public offering is first time. A primary offering is, now we're gonna turn to lawyers now. Cutting this into pieces, and this is one of the things I didn't like about this particular textbook. It leaves out some details that you need in terms of the explanation of this. A primary offering basically is what it sounds like. It's the again, I don't want to say the first time, but it's the beginnings of offering shares. So there could have been an IPO, and then there's maybe some sort of additional shares that are being sold. That's basically what a primary offering is. And so yeah, common stock is, again, what we're all very familiar with. Now, if you're buying shares of Home Depot or Lowe's or something like that, you're basically just betting on the appreciation of the shares, even if you're a big buyer of those shares. Now, if you're a 10% owner in Lowe's or 10% owner in Home Depot, then you have a little bit more, leverage and a little more, bargaining power in terms of dividends and voting for the people running the company, and your say so and how the firm operates, its goals, and the direction of the company. Is it going to be an online company? Is it going to be a brick and mortar store? Those kinds of things. But basically the common stock is after an initial public offering and after primary offerings, the people can sort of, I hate to say speculate and wager, but speculate and wager on the value of the shares of Home Depot, or the value of the shares of Apple or something, or Microsoft or something like that, or Amazon, or what have you. A secondary market is what we're all familiar with in terms of the 6 o'clock news, and we're hearing the price quotes going back and forth. The markets where previously issued securities are traded among investors. So also with the IPO and the primary offerings, there could be a sort of a tie-up time where people, and we were involved in something like this about a little bit more than half a decade ago. Uh, you have to hang. You can't just all of a sudden. So what happens with these IPOs is, let's say you bought in at $8 or $9 a share, $10 a share, and all of a sudden it's the market has it at $35 a share. The second day of the IPO, you can be very tempted to say, "Oh, well, I'm just going to flip my shares for two or three or four times what I bought them for," and that's theoretically and technically possible, but there might be a provision in your agreement to have access to these shares at a very low price, where you've got to hold the shares for 6 months and you can't just flip them, within a couple days or 3 months or 3 weeks or something like that. It could be 6 months, it could be a year, and 250 days of trading activity is a lot of time for the price or the value of some sort of shares of a new company to sort of move around, and you got to be very aware of that. But the secondary market is what we're used to as the stock market. A dividend is a part of the earnings. So when a company has earnings, there's one of two things that it does: it retains it on the balance sheet, or it pays it out to the shareholders. That's it. It goes into two. So if dividends are zero, the retained earnings change from one year to the next is equal to whatever the earnings of the company are, the profits of the company are. But if the dividend is not equal to zero, then a part of the earnings is returned as cash, and then what's left, and that varies just based on the life of the company and how successful it's been, even if it's had a good run or not, those kinds of things. The price per earnings ratio is a very big indicator. It's extreme price per earnings, price per revenue. You want to know if we're spending on, especially for a portfolio manager. Those people care a lot about this ratio. Warren Buffett cares a lot about this ratio. What you're paying for every dollar of earnings. So if there's a company with a PE ratio is 50 versus a company with a PE ratio is 35 or 45, even, or 40 rather, or even lower. I mean, if you can find a price earnings ratio of 20, a dollar is a dollar. So if you're earning it from, if you paid $20 to earn that dollar, you paid $40 to earn that dollar, it's still a dollar, kind of a situation. So that's a very important indicator. Price per revenue, that's among sort of the key ratios, and that type of thinking among the key ratios for portfolio managers to sort of sort through, because they have a lot of decisions to make. They're not just like what I do. I'm focused on one acquisition and one company and one situation. And I have a lot of depth with that. Where the portfolio managers have, thousands of stocks they could pick from. They got to, bulk up the portfolio. What are the returns? And are we looking at a beta? Then you're using a mathematical model to help you decide. You're almost turning into artificial intelligence in a sense. You're having some sort of model that tells you what to do instead of really understanding fundamentally what the company that you're working on is engaged in. Now, this is very typical. If Yahoo Finance or Google Finance or something, the price of this is FedEx. I think it's far lower. These notes are this is 2018, but God knows what FedEx is now. It's probably not 160. That's for sure. Okay, it's probably not. Let's check. Yahoo Finance. What this looks like today. Sorry. There, FedEx Corporation. Okay, it's 181. All right. Let's see. So when was it won? 5 years ago. It was yeah, it was two. I knew it was higher. It was 246 a while ago. It was 290. So it's and this is just a few. This is just 5 years ago. Whatever the max is. Yeah. Okay. This is back to 85. So we could figure. Yeah, this was yeah 240. Yeah, the end of 2018, and the copyright in the book is about 160 or so. But again, I know it was almost 300. So it's taken a bit of a dive. And again, obviously that's the logistics company. And now Amazon is the big, they've expanded dramatically. When as I'm driving around, I see the Amazon trucks as much as I see UPX or FedEx or certainly DHL. You have an open price, a close price, a previous close, a bid price, an ask price, the 1 year target. So now this 1 year target estimate, I don't know if I don't recall Google or Yahoo Finance putting estimates like that, but maybe if you pay for service, you might be able to get some sort of price estimate like in that respect. But I doubt that the Google Finance or Yahoo Finance are putting what we think the price is going to be a year from now just on a public website. I doubt that you're seeing that. What the beta is, which is how volatile the price is compared to the S&P 500, some kind of index, and actually it says next earning date. Okay, so this is 2016. Yeah, this is all 2016. So yeah, that's about what the price was. The days range, the range of the 52-week range of the year, the volume. Now I don't know if it's 556,000 or 556 million shares or whatever, however many shares that. But certainly these companies can have a lot of shares that are out there. So you have to get comfortable with the magnitude of that. The average volume, the 3 month average volume. So yeah, looking at this, it's probably about 600,000 shares. Yeah, because if the average volume is about 2 million, for the last 3 months, what the market capitalization is, it's worth about 45 billion. The last 12 months of price per earnings ratio, the earnings per share, the dividend, and the yield. The yield is what your dividend based on the price, things of that. It's again more ratios, but all of these are all of your diagnostics in terms of how you look at this for a Home Depot, you look at this for an Apple or Microsoft or an Amazon or any of those kinds of certainly the big Facebook, Google, the big technology companies, even the JP Morgans and the Dow, all the Dow 30 companies and things of that nature. And you would make an assessment. But the portfolio managers look at the whole picture as opposed to looking at a specific industry or specific bank or specific stock. I'm more of a special situation person where it's a company where we're really digging into that specific company, and there might not even be the shares might not even be traded anywhere. A bid price, and we'll get into the definitions of this, but here's some of the definitions on the PowerPoints. The price where investors are willing to buy the shares is the bid price. The ask price is what the current shareholders are willing to sell, and you got to find you got to get somewhere in the middle. Okay, you ever see the commercial? I don't know if it's Geico or where it's that life coach, and it's something where he mentors or counsels people returning to their parents. And one of the guys goes, there's like a book signing. His name is not Dr. Drew. What's his name? I forget. But is it Geico? It might be the insurance company where he's at a book signing, and one of the guys he's sort of counseling, he is saying, hey, he goes, how low would you go for this cup? And he goes, no haggling, right? It's in the commercial. It's a funny commercial. um I don't know if I'm looking at that story saying, hey, it's reminding me of me perhaps. But uh, that's the bid ask is what I want to pay, what I'm willing to spend, and what somebody else is willing to accept, and we're engaged, and that's just the constant life of certainly of an acquisition team, that's for sure. That's the constant life of business. Okay, these are just some computations, and again, these you don't learn anything from you don't learn anything from doing this on a what do you call it? You don't learn anything from doing this on the PowerPoints like this. You have to sit and you have to get in Excel and make all these computations. How to compute the dividend yield, how to compute the price per earnings ratio, how to compute whatever. It says payment. We'll figure out what they mean by what kind of payment they're talking about here. But okay, so yeah, the purchase, the acquisition price is really what that is. Um, what we're talking about these terms, you could see the dividend yield. It's the dividend divided by the current stock price. The price for earnings is a ratio is and again, this is 42. This one, I think the average for the whole S&P 500 is in the 30s, 32 or 35, something like that. So even at the time, this is a little expensive, and it did draw down a bit when you're 2 or 300, and now you're 160, and you're still relatively expensive for what your earnings are. That's certainly something you want to figure out why that is. So an investor wishes to purchase 100 shares, a bid price of 159.78, an ask price of 159.99. How much should the investor expect to pay for the shares? Well, you're going with the ask instead of what you want to pay. You're going with the ask of 100, whatever is 100 shares times 159.99 per share. You multiply that through, and then you analyze the price for earnings ratio. You analyze the dividend yield. So again, based on what the dividend is versus what you're paying for that dividend, you're analyzing, how many dollars, for every dollar you spend, kind of a thing. What are you getting in terms of a dividend, and also what are you getting in terms of earnings? So again, it's all, what are you getting for what you're paying? Okay, that's what really. But again, we'll hit this a little bit more when we get in Excel. Now, I don't use FedEx as I'm sad. I had to pick something. I picked Home Depot. We could have used FedEx, and actually FedEx probably would have been maybe a little bit more interesting. And look at this, even though the copyright here is 2018, but you can see this is all in 2015, and this is just a time series of the share price. We made some of these earlier in the fall, and in previous courses. We've done this where we just get a graph of the 250 days of trading data, or a couple of years of trading data, or if you go further back, maybe you'll get monthly numbers, but maybe you'll go back to the 60s for some reason, or whatever it might be. Now, companies have changed dramatically since 65 and 75 and even 85 and 95. So you want to be careful about this whole, this historical path you're going to take back into the, this time, time traveling back to 1972, and say, well, we'll use that as a, not that it's bad, but the world is what it is today. It's a modern version of things, and we didn't know everything that we knew today back in 73 and 75 and those years. But that's a time series. It says the difference between a firm's actual market value and its liquidation or book value is attributable to its going concern value. Factors of going concern include extra earnings power and tangible assets, value of future investments. Well, yeah, and this is a very good slide. We're dealing with this right now, where we have an acquisition that we're looking at, and is it the book value? Is the firm operating now? The problem is the firm that we're looking at is not generating positive cash flows. It's not generating an accounting profit. And the folks who have the firm, and I maybe made the mistake of initially saying, well, book value, which give you the book value, and that's it. And that's a pretty good deal. But even for this company, that might not even be a good deal. Kind of a situation, because it's just it's just not profitable, and the company's taking out loans to stay in business, which never has a good ending. That never has a good ending. Something like that. So anyway, but again, now a new owner can develop earning power, and we can bring in tangible assets, and we could make future investments in the firm. But I think the current owners of the particular firm that we're looking at, I should take a picture of this slide here. Uh, you know, don't have aren't capable, because if they were capable of doing all this, they'd be doing it already. What are they waiting for? Right. And you're taking out loans to keep the business going. So you're just telling yourself something that may not be the healthiest thing, in terms of operating a bank or operating a business. That's for sure. Okay. Again, it's the net worth of the firm according to the balance sheet. But again, you need the real good accounting definitions. Obviously, assets minus liability is generally what the book value is. You really need to understand all the terminology, and when the bank, there's loans and deposits, and how all that works, and securities on the balance sheet, and things of that nature. The liquidation value is the net proceeds that can be realized by selling the firm and paying off its creditors. Well, now, I don't think this firm has any creditors outside of creditors outside the operating the firm, and paying their employees, and having to take out loans to pay their employees. But now, liquidation values generally has a connotation of there's some creditors for a particular firm, which our situation, I don't think there's hardly any debt, but certainly it's just not turning a profit, and that's really what the problem is. But a book value and a liquidation value could be very similar. A liquidation value is what you're going to get in the market, where a book value is a little more of a theoretical number, but those numbers could be the same. The market value of the balance sheet, again, that's a book value is generally based on historical prices or historical valuation where market value is. If we're selling this business today, what are we going to get for its assets? Kind of a situation. I'm sorry to keep messing with this. Sorry about that. Okay. Again, the methods, ratios, multiples. That's valuation by comparables, intrinsic value, the present value of future cash flows from a stock or other security, the dividend discount model. Darren from NYU, we were playing a video in class, and he basically said it. He goes, the way you value, just like the net present value chapter, which is I think the next chapter. This is, I think, it's chapter 8. You have a bunch of cash flows. You're going to pay X dollars, and the rate of return is what you're going to get for if you're investing whatever 40 million or 30 million, and you're getting $5 million cash flows for 5 years. At a certain discount rate, that discount rate is what your rate is. That's what your yield is, or whatever, 20 or 30 million, and you're going to get $5 million cash flows for a couple years or 10 years or whatever it might be. That's really all that is. And the other stuff is you're gauging and measuring, what you're paying here, what you're paying for. Like I said, if you really just go back to this one, actually, just guys, stand by 1 second, just so I don't forget to do this. Sorry. I took a picture of you taking a picture of me or whatever it may have been. Sorry about that. I hope I didn't blind the camera. I want to use that on the call tomorrow. That's a good slide. I want to use that on the call tomorrow. Today. It's almost today. So, and here again, we didn't do time value of money in here, but if you basically look at this, the value today, or a collection of cash flows, a cash flow and another sort of a terminal valuation, which is P1. That's like a terminal valuation, or the predicted price of the stock in a year, divided by 1 plus R, which is the discount rate or your yield for or your opportunity cost for making this particular investment. But that's time value of money. Okay, this is time value of money. Right? Intrinsic value of the shares. It's the value today at zero. T0 is today. A dividend a year from now, end of a period, or the dividend 1, price 1 is the predicted stock price in a year that you could liquidate the company at, and then the discount rate or whatever your yield is going to be. But that's it. That's valuation right there. Is valuation pretty much. Sorry. And it's a little annoying doing that, but I'm going to forget and watch the what do you call it, the highlights of the Giant game or something, and not take those pictures of valuing common stocks. The intrinsic value of a share of a stock if the expected dividends are $3 a share and the price in a year is expected to be $81. So yeah, again, this is a very textbooky. How do you get that 81? And how sure are you about that cash flow, that $3 cash flow? How sure are you about that? And then your discount rate, you're just pulling that 12% out of the air, basically. I mean, we can just go through the exercise and plug in these numbers, and that'll give you a decent valuation. But basically, you have a terminal value, a cash flow, and then your R is just your opportunity cost. That's basically what that is. Now, this is, and I mentioned this in class, the expected. This is just this formula right here. This is just this, but we solve for R, which is the percentage yield of an investor forecast from a specific investment over a set period of time, sometimes called the holding period. Okay, well, there's fancy words in the finance textbook. Basically, if you look at this, this is the yield, and this is the capital gain, right? We think the company be valued at this price in a year. The price today, you divide by the original price. This is the dividend divided by the price today, and that's your expected return, which you're setting that in your initial formula. So you got to be careful. And this is we're just plugging in the numbers, the dividend, the price in the year, the price today, and the return is so we're just kind of going in circles with that. And yeah, I just mentioned this, the dividend yield part, the capital appreciation part. Okay. That's all that really is. Yeah, and now we just did this a little. The dividend yield is a 4% number. The capital gain is 8%. The expected capital gain, you add those together, you get your 12%, or 0.12 or 12%. That's all that really is. The discounted cash flow model, which states that today's stock price equals a present value of all the expected future dividends, sure, and the time horizon T for your investment. And yeah, this is sort of the theoretical version of this. These are all the dividends are all your cash flows, and as you go further years out, you've got to do the you have to do the time value of money mathematics. So every year out adds another number, adds another one to the exponent here. So if you go at 5 years, that's you'll have a 1 plus r to the fifth and 1 plus r to the fourth version of all of these. Okay, and then this is the terminal. That P of t is your terminal value, is really what that is. Okay. And now looking at this, this is just it's if it was this easy, right? Let's just plug in these numbers. So again, how sure are you that these are your cash flows? How sure are you that this is where you in 3 years the company you can get $94 for that share? How sure are you? Now, this is easy, right? You get a seventh grader to do this mathematics, but how sure are you of your numbers? Okay, that's really what's happening here. This part, yeah, the terminal price versus the dividend price. As you can see, the further out you go in terms, now I have a table where I illustrate this, and again, we'll do that in another video. But obviously, the terminal price initially takes over very heavily or weighs very heavily on your valuation, but over time, your valuation is dominated by your cash flows, which is the blue part. Okay, and we've had graphs like this where you had the mortgage payments and how much was interest, how much was principal. And again, these things take so much time where I don't get to hit everything in all my classes. This is in terms of a perpetuity. It says if we forecast no growth or plan to hold out the stock, and definitely they will value the stock as a perpetuity. And again, we had something like this in the time value of money chapter where you just divide by R, and we go through a whole math, which we're not going to do in this video. We go through a whole sort of proof of this. I certainly at Rutgers, I probably proved it one time and forgot that I did it. But you take the cash flow divided by your rate of return, and that's it. And if you look at this, what are you really saying? Well, I'm making an investment today. I have an annual rate of return. So every year I'll get, my investment times 10%, 10%, 10%. So that's what my earnings, that's my cash flow is. I'll say earnings, but my cash flow is 10% times, I spent $100 for a company or 100 million for a company. And so 10% times 100, right? And then got my 10 million a year, $10, however you want to look at it. And it assumes all earnings are paid back to shareholders, and you have reinvestment in the company. So there's a lot of assumptions that make it very clean and easy to sort of look at this, which in the accounting world is made to deal with the details of things changing a bit. So a version of the dividend growth model, and I think we have the definition of who Gordon was, and it's not the guy from the Wall Street movies. It's not Michael Douglas. It's somebody else. But I have who that is. I think he's an English guy or something like that. But we'll discuss that when we get to the Excel part. So I looked it up finally after years of looking at that name and said, who is that? And then we figured out who it was. So a version of the dividend growth model in which dividends grow at a constant rate. So that's the Gordon growth model. And yeah, there you go. So now G was 0 previously. Now G is not 0. So what you're doing is, so if the dividends are growing or however it is you want to look at it, it says, yeah. So it would be your rate of return. So if the growth is 2% and you expect a 12% return, 12% minus 2%, you're divided by 10% and not 12% any longer. So it's a combination of variables in the equation. You can solve for the unknown, sure. And again, but we need an example of that, and we'll hit that. It's what's the value of a stock that expects to pay a 74-cent dividend next year and then increase the dividend at a rate of 5% a year, and definitely assume with 7.8% expected. So this a little messier. So if you expect a 74-cent return or a 74-cent dividend next year, and the dividend, now you could make a table, a 100-year table, which is what I did. That 74 cents can grow at 5%, can grow to a very big number very quickly, easily probably in the thousands, if you can believe it. And you expect 7.8% return. What's the value today? And again, we have an example of that, but this is just a simple where you look at the next year and just defining all of the pieces here, what your rate of return is, and what the growth rate of the cash flows are, and how that impacts the valuation today. But this is all really good stuff, though. There's other stuff. We're getting complicated now with these things. This is so 22. Over half. Payout ratio is the fraction of earnings paid out as dividends. Plowback is a fraction of earnings retained by the firm. So as I said, for every dollar of earnings, it can either, a percentage goes as a dividend, a percentage goes back to the balance sheet, to the equity section as a retained earning. Now, if you pay out no dividends, it all goes back. So if the fraction of earnings retained by the firm, if you have no dividends at all, that's 100%. The plowback is 100%. Or if you're paying out a lot of your, and I've seen situations where for various reasons, firms are returning a lot of cash. Either they're probably planning on shutting the firm down or something to that effect. The payout ratio could be a big fraction of the earnings. Sustainable growth rate if it says it says the firm's growth rate if the plowback is a constant fraction of earnings, maintains a constant return on equity, and keeps the debt ratio. So yeah, we're getting very idealistic with all. Again, you're looking at a very clean version of things and a going concern and a company that's running itself kind of a situation. The accounting analysis is what I've again just in my experience. Not that this stuff isn't important, but the accounting analysis is really you want to focus a lot of your energy on initially in your careers. That's for sure. Growth can be derived from applying the return on equity to the percentage of earnings back to the operating. So again, people taking all these ratios, and if the ratio does this, if the ratio does that, how's the stock price going to do? What's the value of the firm going to do? So this is the present value of growth opportunities, net present value of firm's future investment. And again, you want to fit these very nice sounding ideas into the work that you do, but it's got to be in a way where you can explain it to people and it makes sense. Okay, just keep that. Don't say, oh, plowback or sustainable growth rate. Okay, then what? Return on equities is important based on what was invested and what's the net income or the net earnings based on the capital that was invested in. And Warren Buffett would call that ratio a very important ratio. That's for sure. And we have this example in the Excel. This is Aqua America, has a return on equity of 12.5%, a book value per share of about $10, and intends to plow back 40% of the earnings, and the opportunity cost of capital is about 8%. What's the stock price? So yeah, and again, so you're doing a valuation just based on all these other ratios. How sure are you of this? How sure of you of the book? Well, actually, this is the one to most be unsure of, and this number. And so again, all the four inputs here. How do you feel? This is all just numbers moving on the page, but again, going through the exercise of this, if you have a book value, if you have the return on equity, and I'm sure we have formulas in the Excel that go through it. I'm just introducing these ideas to you, what the growth rate is. So if the growth rate, looking at this, if you're plowing back at 40% and your return on equity is 12%, we've gerrymandered the mathematics to say, well, 12.5 times 0.4 gives us about a 5% growth rate. And then you look at the dividend and how the dividend behaves. So if you're plowing back 40%, right, in terms of you look at this is earnings per share. If you're plowing back 40, you're paying out 60. So 60% of the earnings per share goes to the shareholder, which is how you get the 74 cents. So this 74 cents, and then you take 40% of this 123, that adds up to see, this is earnings per share. And this is right. That's 74. So right. So the whole earnings per share is 123. So 74, and then maybe another 50 cents would be the other 40%. Those added together have to give you $1.23, and then the value today, what we're all searching for. But again, this number is only as good as what you're inputting, and you don't want to just sit there doing arithmetic, kind of a situation. So. This, and again, it's hard to do these on the PowerPoints because you're moving around a bit. If it says there's another scenario where if the company doesn't invest the earnings, what's the value of the stock then? Well, then if it's not reinvesting, it's 100%. The dividend is 100%, kind of a situation. And then how do you determine what's different about one versus, so you're not subtracting out the 5% growth rate any longer and things of that nature. So again, so you can make some changes to the scenario and get a different valuation. See a version with growth, a version with no growth, and how that changes the how that changes the valuation, right? A $5 dividend next year, 100% earnings, 12% return, 40% plowback. The return on equity could be 20%. So again, we have another version of these, and again, I'm sure that we have these all over the Excel, and we're gonna go through that mathematics as we need to do this. And now, again, the version between, again, the scenario between a no growth scenario and a growth scenario, you could have almost double the valuation. So, and you could have varying factors that influence what your valuation is. Always just keep that in mind. But this is the big formula: is this valuing a non-constant growth version. where again you're identifying 10 years or 20 years of cash flows and dividends and that kind of a thing, and working out the valuation at that point. This example, you have a discount rate of half, a perpetual growth rate of 5%, which begins in year. And again, these things start in different years. And again, the acquisition work, I couldn't say, well, in 3 years, we're going to have a perpetual growth rate of 5%. I couldn't say something like that. I mean, this becomes a mathematical exercise. But like I said, what you're basically doing is you're looking at earnings, and you're going to have 60% of the earnings as your dividend, so your cash flow. So obviously, all the numerators of these numbers, you can see 417, 379. So to go from the earnings line to the dividends line, you're taking 60% of these numbers, and the other 40% is invested back and it goes back to the balance sheet. And then you're 1 year out. This is 1 year out, 2 years out, 3 years out, boom, 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 5 years out, kind of a thing, right? You have all that. So you have the present value of, now again, you want to weigh the present value for the first couple years, which might seem like a relatively easy computation, but then this 125 versus the 13, this is whatever. This is this is 5 or 6 times, or whatever, 7 or 8 times that number. So you're gonna say, hey, you don't want to leave out 80% of your valuation that you just made this kind of a computation, and that's it. There's some other number here where, in terms of perpetual growth, in terms of the rate of return, and so you take the 4.17, and then in perpetuity, you've made this computation. You're summing this part and this part as sort of a perpetual number. So you got to keep that. You got to keep that in mind. So what you do is you take that last cash flow and say, okay, well, we'll have that cash flow for the next 75 years. What's the valuation of that? And really forgetting about the growth piece of this, I would take the 417 just divided by 0.85, and I think that you probably get a pretty close number to this 125, and then you add it to this one, and that's pretty much how you hit that. Earnings and dividends, again, discount rate, perpetual growth rate. And again, this goes through what we did sort of in year 6 here. So this was 1350. Yeah. So now you brought back at the end of year 5, you got the time value of money. You brought that back to today, right? So gave you $96 valuation, which again, which is about, that's $6 out of $7 almost is this number or thereabouts, right? That's about $6 out of $7 is right there. So you don't want to avoid, even though it might seem a little theoretical, but that whole the in perpetuity number, right? That's a big part of the valuation. But again, my guys aren't going to have a time horizon of 100 years or 50 years. Okay, it's the time horizon for a couple years, and then can we sell this company? It's some, after a couple years, might we be able to sell it, kind of a thing. This technical analysis, I do have an example of this. Investors who attempt to identify undervalued stocks by searching for patterns in the past stock prices. Yeah, we're here. Okay. Yeah. So and this is just a very generic symbol for technical analysis. You want to forecast the stock prices based on the fluctuations in the historical prices. The wiggle watchers. I've never heard that term, but okay. So yeah, that's that one. So we make all these graphs. These are the returns, and you could compare one fund to an index fund, and which fund is doing better. And if you look, this particular comparison, I don't know. Anytime the purple one is a little bit higher, that's an unmanaged fund, and that's generally, and if the purple one is a less of a loss, and it looks like a lot of the time the purple one is better. There's 1, 2, 3, 4, 5, 6, 7, 8. So you want to go through all the years of this and determine, is just leaving your capital in the S&P 500 or paying a guy to buy and sell over the year. Which one of those is going to give you a good return? And you got to be careful. See what it says, average annual return. right? It's the return. It's not what the index is. It's what the return is. It's what the change is from one year to the next. So you want to keep that in mind. You want to be very careful of indices versus percentage changes. And I've tried to drill that into you guys with the personal consumption examples that we've used in class. And getting to the home stretch here, I took Burton Maykill for random for corporate finance, the guy who wrote a random walk down Wall Street. All I remember he was up there scribbling. I took him way at the end of his career. He was scribbling some stuff on an overhead and not using Excel at all. And I sat there, said to myself, So anyhow, but security prices change randomly, and they could. Now that's his idea with no predictable trends or patterns. So statistically speaking, the movement of stock prices is random and generally skewed positive over time. And that's just saying that a rising tide lifts all boats. Basically, is really what that says. Yeah, looking at this, this is the whole tree analysis where you flip a coin, the stock price is 103 or 97, 106 or 100 or 195 or whatever. And if you just keep making all these decisions, buy FedEx, sell Home Depot, buy Apple, sell Microsoft, and at the end of all your deltas add up to a better version that someone maybe studied fundamental analysis or maybe looked at it in a different way. But let me tell you, even a random version of picking stocks, I think is a technique, in my humble opinion. This is the S&P 500. Oh no, yeah. The question is, looking at this, so whatever level means, it says, is it the S&P 500 trend or is it 5 years of the coin toss game? Okay, so I guess they're asking that question. Say, does this graph represent the behavior of the S&P 500 index, or does this graph represent the behavior of just flipping a coin and picking certain stocks and what the returns are, or something to that effect? And then I think those are both the same. I think that's what the answer is. Those are probably, one of them is probably the coin toss, and the other one is probably the S&P 500, and they're almost having a similar trend. This is a scatter plot of the return this week and the return the previous week. We make this in Excel, so don't worry about that. We're going to be making something like that. This is cycles disappear once they're identified. Yeah, I mean, once there's an opportunity or and I remember I read the long-term capital management book a couple of years ago. I reread it after reading it at Fordham. That some of the trading strategies and philosophies used by long-term capital management up in Connecticut were being used by a lot of other firms, as the firms would read into, because we have an open system in a sense where people can see what firms are buying and selling out in the markets. Once the results of long-term capital management were sort of identified, and then those opportunities began to dissipate because other people were trading into them maybe faster or not to the expectation of long-term capital management, and then those mispricing opportunities were sort of vanishing, and that's all this really says. So actual prices, as soon as an upswing is recognized, then you have the upswing, and this is just these guys. Who knows what they're trying to communicate here? I wish they would explain what this graph is. It's got 4 different colors and a couple different lines here. But again, not really accountants, not really math guys, but probably successful guys who wrote these books. That's for sure. So, fundamental. This is what if I had to characterize what I do. It's this: investors who attempt to find mispriced securities by analyzing fundamental information, accounting data, business prospects, research the value of a stock using net present value, and other measures of cash flow. I'd call value line the fundamental analysts, and then you have efficient markets, and you have a bunch. This is people trying to be physicists. Is really semi-strong. Is this physics? Is nuclear physics? There's the semi-strong force, the weak force. So people just sort of reuse those words and applied it to the investment industry, or the money management industry. Market in which prices reflect all available information, all historical information, all publicly available information, both public and private information, and we've labeled all those various scenarios. Good luck with that. Impact on leaked information. Well, again, there's a lot of folks at Yale and Princeton trying to quantify, these things. That's for sure. And saying, oh, well, if you leak some information 2 days or 3 days ahead, what's going to be the impact on the stock price? It's the situation that you're in. Know some good accounting, have some good political contacts, and I think that's going to serve you well. So the average return from 72 to 2001 of stocks of firms over 6 months following the announcement of quarterly earnings. So the 10% of the stocks with the best earnings news outperform those with the worst news by about 1% a month. So obviously, well, I mean, look, if a company's more profitable, has higher earnings, and have a higher valuation, that's what this picture's trying to tell you. Okay, and now, well, when the news came out, well, now these days everything is sort of, disclosed, even theoretically evenly to all the interested parties, out in the world. That's for sure. Existing anomalies, old anomalies, small firm effect, the January effect, the PE effect, the value, whatever I worked at Value Line, whatever. I don't even know what the Value Line effect is. But does that mean that once Value Line starts covering you, does your price go up or down? I don't know. It's probably momentum factor, new issue puzzle, attitudes towards risk, beliefs about probability, sentiment. Oh, that's the Michigan survey. The Michigan survey is about expectations, sentiment, and confidence. Right? That's the Michigan survey. Okay, folks. Thank you for taking some time and paying attention through all this stuff, and my criticism of the book and the field and the industry and all those other kinds of things. So work on your final exam material. Work on your final exam material, and spend some time on this stuff, and we'll catch up soon.